Most people think financial crises begin with headlines. They don't. They begin quietly, inside laboratories, patent filings, and factory floors no one is paying attention to. Long before prices explode, long before analysts scramble for explanations, the math is already locked in. Right now, while this video plays, one of the world's largest technology companies is making a decision that doesn't just affect electric vehicles, batteries, or even the tech sector. It directly threatens the stability of the global silver market, and by extension, every currency tied to it. This isn't speculation. This isn't hype. This is arithmetic colliding with reality. As you're watching this, Samsung is constructing manufacturing facilities in South Korea that are set to fracture the global silver market at its foundation. Not potentially. Not hypothetically. Inevitably. And here's the part that should unsettle anyone still comfortable holding dollars. The numbers are no longer theoretical. They've been confirmed. On January 9, 2025 at CES in Las Vegas, Samsung Electromechanics CEO Chang Duk-hun stood before the global tech press and openly confirmed what precious metals analysts had been whispering about for months. Samsung's solid-state battery is no longer experimental. It's production-ready. Mass manufacturing begins in 2026. Prototype units are already in customer testing. But buried inside the technical documentation was a figure that changes everything. 5 grams of silver per battery cell. Translated into Wall Street's language, that number means one thing: stress, systemic stress. Here's what Samsung actually engineered. Their oxide-based solid-state battery relies on a silver carbon composite layer embedded in the anode. This isn't a marginal upgrade. It's the breakthrough that finally solves the dendrite problem, the needle-like lithium formations that have trapped solid-state batteries inside laboratories for decades. Without silver, the battery fails. Copper won't work. Aluminum won't work. There is no substitute. The silver carbon layer, just 8 to 12 micrometers thick, is precisely engineered, patented, and non-negotiable. It exists because physics demands it. Now here's where the math turns brutal. A standard 100 kilowatt-hour electric vehicle battery, the size used by Tesla, BMW, and other premium EVs, requires roughly 1 kilogram of silver. At December 12, 2025 pricing of $64.47 per ounce, that translates to approximately $1,071 in raw silver per vehicle, before refining, processing, or manufacturing costs are even considered. Pause on that. Every vehicle rolling off the line with Samsung's battery technology requires more than $1,000 worth of silver, just for the battery. Not the car. The battery alone. And Samsung isn't building a boutique product. They're partnering with BMW. They're in talks with luxury automakers. Their pilot line at the Suwon Randi Center is already shipping samples. Samsung SDI is targeting 900 to 1,000 kilometers of range by 2027, roughly 550 to 620 miles on a single charge. Charging time? 9 minutes. Battery lifespan? 20 years. Range anxiety disappears. Fire risk disappears. Replacement cycles disappear. But here's the number that should make your stomach tighten. Global vehicle production reached 75 million units in 2024. If just 20% of that output, around 16 million vehicles, adopt Samsung's silver-based solid-state batteries, the EV sector alone would consume 16,000 metric tons of silver every year. Now compare that to reality. Total global silver production sits at roughly 25,000 metric tons annually. Mexico contributes about 6,000 tons. China adds 3,500. Peru supplies 4,200. That's the supply. There's no hidden reserve waiting in warehouses. Samsung's technology, at just 20% adoption, would absorb 64% of the world's entire annual silver output. And that silver isn't idle. Solar panels already consume around 20%. Electronics take nearly 30%. The rest goes to jewelry, coins, medical applications, and industrial use. It's already spoken for. Think of it like this. Imagine earning $50,000 a year, and someone suddenly demands $32,000 of it, 64%, for a brand new expense. But your mortgage, food, transportation, and family costs are already locked in. You can't magically generate more income overnight. That's where the silver market stands today. The market knows it. Silver hit $64.47 on December 12, 2025, up from $31.96 just 1 year earlier, a 103% surge. It briefly touched $61.44 intraday on December 9th before accelerating higher. This isn't retail speculation. This is institutional capital positioning ahead of an unavoidable constraint. ETF data confirms it. In just the first half of 2025, 95 million ounces flowed into silver-backed ETFs. Pension funds don't do that for entertainment. Hedge funds don't warehouse metal for nostalgia. They do it because their models are flashing red. Lease rates in London are spiking, clear evidence of physical delivery stress. COMEX inventories are thinning. Shanghai warehouses are being drained. These are the signals that appear before supply crises, not after. And here's the part most people miss. Samsung's public announcement came in January 2025. The rally began earlier. Smart money read the patents. They studied the Nature Energy papers published back in 2020. They ran the numbers long before Bloomberg printed a headline. By the time the story becomes mainstream, the easy positioning is already gone. So ask yourself this. What happens when a metal and structural deficit becomes mission critical to the largest technological transition of the decade? What happens when the world's biggest manufacturers compete for a resource with no substitute? You're about to see. Samsung is placing a $52 billion bet on a battery technology that relies on a metal already undersupplied. Not a future shortage. A present one. The Silver Institute projects a 95 to 149 million ounce deficit for 2025 alone, before Samsung scales, before BMW ramps production, before Toyota's 2027 solid-state rollout even begins. This isn't a classic supply and demand story. This is inevitability meeting industrial scale, and the clock is already ticking. If silver's price movement has felt different lately, this is why. This isn't inflation fear. It isn't currency panic. It isn't speculative frenzy. It's physics. Samsung uses silver not because it's optimal, but because it's the only material that works. 1 kilogram per vehicle. That number isn't shrinking. It isn't negotiable. And Samsung isn't alone. Toyota, Nissan, Volkswagen, GM, all are racing toward the same destination. Batteries that charge in minutes. Last decades. Erase range anxiety permanently. They all require silver, more than current production can supply, more than mines can deliver on their timelines. The squeeze has already begun. Institutions are positioned. Prices are reacting. The only remaining question is whether you understand the math before it becomes obvious to everyone else. New mining supply doesn't appear because prices go up. It appears because years of groundwork finally come due, and that groundwork takes a decade or more. From the moment a silver deposit is discovered, you're looking at 10 to 15 years before a single ounce reaches the market. Geological verification, environmental impact studies, government permits, negotiations with local communities, infrastructure build-out, equipment procurement, skilled labor training. Each step is sequential, not optional. Even if a company uncovered a world-class silver deposit tomorrow, and somehow fast-tracked every approval, you wouldn't see production until the mid-2030s. That's not pessimism. That's the industry's historical reality. Recycling doesn't save you either. According to World Gold Council research on precious metals recovery, only 18% of industrial silver is ever recycled. The rest disappears into solar panels, circuit boards, electronics, medical equipment, spread across billions of products in quantities too small to recover economically. At $64 an ounce, it still doesn't make financial sense to extract silver from a discarded smartphone or a cracked solar panel. The energy, labor, and processing costs exceed the value recovered. So supply stays constrained. Global mine production totaled 25,500 metric tons in 2024. Early estimates for 2025 point to roughly 25,000 tons, a decline despite record prices. Why? Because silver is mostly a byproduct metal. Around 70–80% of global silver supply comes from copper, lead, and zinc mining. When base metal markets soften, as they have, silver output stagnates or shrinks, regardless of silver's price. Copper miners don't increase production because silver rallies. They respond to copper demand. Silver just tags along. The numbers are clear. Mexico produced 6,000 metric tons in 2024, the world's largest contributor. Peru followed with 4,200 tons. China added 3,500 tons. These top producers all face the same obstacles. aging mines, declining ore grades, tightening environmental regulations, and indigenous land disputes that delay or halt expansion. You can't print silver. You can't vote it into existence. And you can't replace it when applications demand its unique physical properties. The solar industry already ran this experiment. In 2015, photovoltaic panels consumed roughly 75 million ounces of silver annually, about 2,300 metric tons. Manufacturers immediately recognized silver as a cost problem and launched aggressive, thrifting programs. Copper pastes were tested. Efficiency collapsed. Aluminum alternatives corroded. Every workaround failed. They optimized everything they could. And yet, by 2025, solar panels accounted for 20% of total global silver demand. Why? Because solar deployment expanded faster than engineers could reduce silver usage. Each panel still requires roughly 0.65 grams of silver per watt according to International Energy Agency data. Multiply that across global solar expansion and you get demand that refuses to disappear. The industry tried to engineer silver out for 10 years. It didn't work. Samsung's batteries follow the same blueprint. Inelastic demand colliding with fixed supply. The difference is speed. Solar took 3 decades to reach 20% penetration in leading markets. EVs are projected to reach 20% of global new car sales by 2026, according to Bloomberg NEF. And Samsung isn't alone. Toyota targets 2027-2028 for solid-state EVs with 750-mile range and 10-minute charging. QuantumScape, backed by Volkswagen and Bill Gates, is racing forward. Solid Power partners with BMW and Ford. Factorial Energy works with Mercedes-Benz and Stellantis. Different companies. Same conclusion. They all hit the dendrite wall. They all ran the same experiments. They all arrived at the same answer. Solid-state batteries require materials with extreme electrical conductivity and mechanical stability. Silver delivers those properties better than anything else. Here's what makes this situation uniquely dangerous. This isn't one company taking a risk. This is the entire global automotive industry, an $8 trillion sector producing 75 million vehicles a year, converging on a technology that depends on a metal already in permanent deficit. This isn't a hypothetical shortage. It's math meeting manufacturing timelines. And unlike previous commodity squeezes, this one has no natural release valve. Supply can't respond. Recycling can't scale. Substitution isn't possible. The physics doesn't bend. The chemistry doesn't negotiate. 1 kilogram of silver per 100 kilowatt-hour battery pack. That number is locked in. Samsung has already committed $52 billion to bring this technology to market. BMW is preparing demonstration vehicles. Toyota is accelerating development. Production schedules are public. Capital has been allocated. The squeeze didn't start in 2027. It started the moment institutional investors read Samsung's Nature Energy paper in 2020 and ran the numbers. That's why 95 million ounces flowed into ETFs in the first half of 2025. That's why silver doubled in a year. That's why lease rates are climbing and COMEX inventories are draining. Now let's look at the math institutions are already trading. Global production, 25,000 metric tons per year. Current deficit, 149 million ounces. Samsung at 20% EV adoption, 16,000 tons of new demand. That alone equals 64% of global supply. Add existing deficits and total shortfall jumps to 19,000, 20,000 tons annually. And 20% adoption is conservative. At 80% adoption, once consumers experience 600-mile range, 9-minute charging, 0 fire risk, and 20-year battery life, the math turns catastrophic. 64,000 tons of annual demand against 25,000 tons of supply. There is no solution. You cannot mine your way out. You cannot recycle your way out. You cannot innovate your way around it. So here's the timeline markets are already pricing. Early 2026, Samsung begins mass production for wearables. Silver tests $75, $80. ETF inflows surge. Mining equities rally. Media starts explaining the shortage. Mid-2026, BMW prototype data goes public. EV valuations adjust. Commodity desks build long-term positions. Silver moves toward $90, $100. Late 2026, volume contracts get signed. Industrial buyers lock in multi-year supply. COMEX inventories fall below critical thresholds. Silver breaks historical resistance and enters true price discovery at $120, $150. By 2027, mass market delivery begins. Toyota joins Samsung. Governments panic. Export restrictions appear. Silver trades $150, $200 with spikes higher if delivery failures occur. And if COMEX breaks, if physical delivery fails, prices don't stop at $200. They jump to $300, $400, $500, not over years but over weeks. This isn't speculation. This is industrial mathematics. Samsung didn't just build a battery. They turned silver into a strategic choke point. The squeeze is already underway. The timeline is locked. And physics doesn't care who's paying attention. When the world figures it out, it won't be early anymore.